All right, let's stay on the markets here and bring in Charles Schwab, Chief Investment Strategist, Lizanne Sonders. Lizanne, always great to see you here. We are right in the middle of earnings season here, and I have a chart I want to pull up here because we are seeing before earnings season estimates for profits really go on an uptrend. I think that would surprise a lot of folks given what we are seeing with inflation and rising rates. Are you surprised that the street is taking up their estimates, and does that set the table for disappointment?
Well, we may be at the first quarter in 6 or 7 quarters where analysts might end up moving estimates up a little bit too much, to your point of the question about setting up for some weakness. We also have the fact that right now the blended consensus, which is the 10% or so of the S&P that is already reported combined with consensus for what's left, is decent, 6% and change for the S&P, but ex energy, it's close to flat. And again, we're only early in the season, but we've got a lower beat rate than what the trend had been from the lows of a year and a half ago, and the percent by which companies have beaten. And then revisions going forward, as well as pre-announcements, are more biased toward the negative side. So in aggregate, earnings will still be positive, but I think some of the underlying trends are certainly weaker for the first quarter.
And let's also talk about underlying trends, Lizanne, in the economic data. I was just reading through your commentary from yesterday, and you talk about that people need to pay attention to not just the absolute level, but sort of the direction. It doesn't matter so much if economic data is good or bad. It matters if it's worse or better. And then you outlined some numbers that are not so great in your commentary. So how are you feeling about the overall economic picture right now with all the recession talk out there?
And I think the trend versus level is always important. I've said for 3.5 decades that I've been in this business that better or worse tends to matter more than good or bad. It's human nature for us to look at economic data, whatever variety you're talking about, and think of it in strong versus weak, good versus bad. But it's that second derivative. It's a rate of change, especially as you're approaching a potential inflection point. We know growth is slowing. The burning question right now is it a mid-cycle slowdown or ultimately a harder landing into a recession? And you have to focus on the leading indicators, but not wait until the point where in level terms they have started to look weak. You want to look for the start of deterioration, which certainly not across all the leading indicators, but in the case of some, you've started to see a bit of that deterioration. And it just means you want to be on watch for further deterioration such that it gets to the point of recession conditions. We're certainly not there yet, but if things continue to worsen, I think the odds go up.
Well, then how do you invest in this type of backdrop, this uncertain backdrop, Lizanne? On one hand, you have utilities still rocking. They're really boring. Who wants to invest in overvalued utilities? But then you have tech stocks that have taken a beating, and there might be some values there.
I think that the trend in interest rates, the move up in the 10-year yield to 2.9 has put downward pressure on the more highly valued segments of the market. Clearly, the underlying shift toward defense, not just in the very recent period, which has been a choppier market period, but even in the 3 or 4 week period in March, where we had the rallies off the early March lows, that was not driven by cyclical segments of the market. So I think the underlying message coming from the market beyond just looking at the index level is one of slowing growth. I think you have to be really careful, though, because in the case of a sector like utilities, they're actually trading at a richer multiple than the S&P. So even though they live in value indexes, they don't really offer a lot of value from a factor or characteristic perspective. We've been recommending that investors, especially those that do it on their own, they're stock pickers, focus more on factors and the umbrella around factors that we think will continue to be generally in a leadership position is quality. And that encompasses not just certain value characteristics like strong free cash flow yield, strong balance sheet, but also more hybrid into growth characteristics like positive earnings revisions in an environment where we don't have as many positive earnings revisions. So we think that factor-based approach is the way to tackle a very difficult market at this point in the cycle.
So, Lizanne, that sounds like then if you're applying that factor-based approach and looking for those characteristics, that you're not going to get sort of an umbrella sector weighting, right? To come back to that old saw of it's a stock picker's market, if you apply that screen, is that fair to say?
Absolutely. In fact, I think there's this misperception that to look for value, you're limited to the sectors that generally live in the value indexes. I already used the example of utilities living in the value indexes, but not offering a lot of value. You can also find value through screening in sectors like technology that for the most part live in the growth indexes. I often describe it as there's growth and value uppercase G and V, which are the indexes labeled as such and what their constituents are at the sector level. But then there's the factors or characteristics of growth and value lowercase G and V, and you can apply an analysis on them and a search for them across all the sectors. You don't have to limit yourselves to just certain boxes, style boxes that they live in.
Lizanne, thank you so much. Good to see you. Lizanne Sonders is Charles Schwab Chief Investment Strategist. Appreciate it.